to BQ Prime as we continue with our monetary policy coverage. Policy today was largely in line with expectations. The RBI reduced its rate hike quantum, raising the repo rate by 35 basis points this time round. It was also divergent, again, in line with expectations. Core inflation continued to remain a point of concern. Joining us to share their thoughts are Arvind, Chari and Aurodeep, Nandi. Thank you so much for taking time out. Aurodeep, I'd like to start with you. What are your broad thoughts and broad takeaways from today's policy?
I mean, I know that the way markets are seeming to interpret this is that it's hawkish, but I think it's there's a nuance to it, right? Because on the one side, yes, on the face of it, it does sound a bit hawkish. We are using battle terminology for inflation, that the battle is still on, and that inflation is very sticky, and we've got to. It's still something that's got to be controlled. Also, the fact that the governor mentioned that look, policy rate X inflation still remains in accommodative territory. We also have this withdrawal of accommodation stance, which different people have different interpretations within the MPC, but broadly one would assume that it still means that there's some degree of accommodation that's still got to happen. But I guess the nuance that sort of comes in is that Governor Das also ended the speech saying that look, we've done a large quantum of hikes, and the future rate action is going to be data dependent, right? And also, he's said in the past that during hiking cycles, it's not a practice that he likes in terms of giving forward guidance. So really, the key question for us is whether the hawkish talk translates into a hawkish walk in Feb. And our baseline case is that there is still going to be another 25 basis point hike in Feb, but it is a close call, especially because we have. We are penciling in recession across many developed economies next year. So the growth inflation debate is likely to flip come 3-4 months later, right? We'll actually be talking much more seriously about growth. So we have 25 basis points hike in Feb, then a pause, and but it's likely to be a close call. Incidentally, we've penciled in 75 basis points of rate cuts in 2023 in the second half. So we do think that the way the growth inflation dynamics are going to play out, that come second half of 2023, actually the monetary policy cycle will come.
Okay. Arvind, what are your thoughts, especially on the commentary around inflation today morning?
I think they had to, say what they said on core inflation, right? Because headline inflation is now what expected to be about between 5 and 5.5 if I go towards the Q1 and Q2 FY24. But their headline target is still 4%, right? We've forgotten about that, but I think they've reminded in the last two meetings that their actual inflation target is 4%. Right, I think you will see them using that a lot more. That they want to get inflation back to the 4% level, and that's possible by getting by core has to come towards 5, and then food has to behave and remain around 4. It seems very, very challenging given the way things are right now, given the increase in cereal prices, wheat and rice both. But that's the objective, right? Or a period of time, they would want inflation to head back to 4%. So the fact that they are focusing on core inflation as a means of, their one aspect of their guidance is for people to think about. I agree with Aurodeep in the sense that, despite all that, markets and most people expect another 25, maybe 50 for this cycle. And, that's where I think the nuance of that comes from what we mean by this cycle, in the sense that there are still so many moving parts. And I think RBI was smart enough to, sound hawkish, but as he said, as Aurodeep said, maybe might not walk hawkish, because the Fed is still active. The Fed is still live, and uh, the pace of rate hikes will surely slow down. But when, how much, do they give guidance? And given the GDP growth data or the economic data that we have seen in the US, services activity, wage growth, I think the jury is still out, in the sense that, there is a recession that is getting predicted. But before that, the Fed has an inflation challenge. And how much more they can wait for that headline inflation to come towards, say, 3%, not even 2. I think that will drive monetary policy. So from RBI's perspective, I think it is smart to sound and appear hawkish, but at the same time, I think it was Dr. Patra who said there's a winds of change, like, the 50 coming to 35. So instead of a 3 consecutive 50 basis point hike became a 35. Next will become a 25. So they are recognizing the fact that, in Indian inflation is not as high from its normal long-term averages. So there India still has some buffer. But the perennial worry that they have on the INR would mean that they will have to at least sound and appear hawkish. And I think maybe they will do more of that through liquidity, where they tighten liquidity, and maybe they seem to be moving liquidity to a aspect of quantum of liquidity, like the amount of liquidity available in the system, as compared to the price of liquidity. So I think you should expect them to maybe take liquidity to deficit over the course of the next 3 to 6 months, and that has its own monetary policy transmission impact. So you might not see rate hikes, but you might see tighter liquidity in the markets.
All right. Already, we saw GDP figures come in last week, and while the headline figures were broadly in line with expectations, again, there were areas of concern. Manufacturing was, for instance, in contraction. That, along with current high-frequency indicators, what's your reading of the state of the economy at this point?
So, Pallavi, I think the cyclical growth cycle has turned. Right. So yes, there's a lot of talk on festive demand picking up, etc. But once you account for that seasonality, once you take out sort of the base effect, and you just look at the way consumption, investments, industry, even services, as a matter of fact, that sort of enjoyed this post-pandemic reopening boom, all of it there's been a broad-based slowdown. That sort of the peak happened somewhere in Q2 of the calendar year. And then ever since, actually, indicators have been on a moderating cycle, even for consumption, even for things that people like to talk about, that, hey, look at car sales, or look at mobile phone sales. It's a very skewed, lopsided model, right? So much of it is driven by better off consumers, while it's the bottom consumers that are facing the brunt of higher inflation, pandemic scarring. So, for instance, even in passenger vehicle sales, you've got the entry-level cars. Actually, the demand for that is much lower than the higher end ones. Similar is the story for two-wheelers. I think going forward, we are considerably worried about growth. In fact, for FY24, the RBI, I think, has around 6.5%. Our number is 5.1%. And that's primarily because I think there's a lot of sense that, India's growth chal jayega. But I think what people often forget is that, next year we'll probably have recessions in across developed markets, right? Across US, Euro area, UK. And in the case of Fed, I think there is a very strong commitment to get inflation down. How do you get inflation down? By sort of slowing down the economy, by weakening the labor market, which at this point is actually quite strong. So, our expectation is that the Fed increases rates to around 5.5 to 5.75% by mid of 2023. And unlike recessions of the past, you don't have counter-cyclical policies available, right? So you're not going to be in a situation where, oh, growth is slowing down, let's bring in monetary stimulus, let's bring in fiscal stimulus. In fact, what you're trying to do is use monetary policy to bring down growth in economies like the US. And if you look at India's growth cycle, we just compare it to global growth cycle. There's hardly been a phase where India has done well in a situation where global growth has done badly. So, we do expect that the export slowdown is going to be quite high. In fact, even before a recession has actually hit, we are tracking a minus 17% odd in terms of export growth. And secondly, India's capex cycle is actually linked quite closely to the external and the export cycle. So, you've got consumption that will moderate somewhat from where it is currently, still remaining probably, K-shaped, depending on how you define K. And but you'll have exports getting hit, you'll have private capex getting hit. So actually, we are quite concerned on the growth side, which is precisely why we are starting to think that, look, we're talking so much about inflation now, but if growth really hits a 5% handle, will the RBI sort of just sit back and say, no, we're still aiming at 4%, or is it going to push back its 4% target and say, I've got to start acting on growth, which is why we've penciled in 75 basis points of cut. But yeah, we're on a whole, we are much more bearish on growth than consensus or RBI.
All right. Arvind, is the RBI worried about maintaining a certain interest rate differential with the US, you think?
See, that will always be on the back of their mind, right? Now, think about a situation where the BOP goes into a large deficit, right? Typically, we always used NRI deposits to bridge that, right? And historical cases have come at a situation where global rates have not been that high. So India has been able to attract a lot of NRI deposits. But today, if you look at cash rates globally, 3.5%, 4.5%, more or less, right? So if you have to attract 2-year, 3-year deposit money to bridge your BOP deficit, India will have to actually offer a fairly substantial subsidized, rate, so that you can absorb, you can attract. Like in 2013, we did 36, 26 plus 9, that NRI deposits and bank capital. Global rates were not that high, and India was able to attract, but India rates had gone to like 8-9%, right? So that is one aspect to think of it. If the other way to bridge the capital account or a potential BOP deficit is by bond flows, like foreign FPI bond flows, and say, for example, India gets into the bond index, or even if it doesn't, to be able to attract 15, 20, 25, $30 billion of FPI flows into Indian debt markets, you again need to have attractive rates, both on real terms as well as nominal and real. So that is always that will always be a factor that the RBI will have to think about. There is no clear easy math to it. So if, as Aurodeep said, if Fed goes at 5.5 and RBI say holds at 6.5, then it's only 100 basis point differential, which is on a historical average very, very low. Like average history, I think Aurodeep will correct me, but about 350 basis points or 400 basis points would be the long-term average. So but you have to understand that inflation cycles in the developed world are very, very different this time around. Whereas inflation cycle in India is high, but not as high as compared to its long-term average. And as Aurodeep said, if we are fairly much slightly more optimistic on the growth recovery than what Aurodeep is. Purely from a structural perspective, I think India had a 7-8 year downturn starting in 2012. And maybe we are seeing that structural upturn. So maybe cyclically, 2-3 quarters, especially a global recession, will impact it. But there is a certain demographic, there's a certain balance sheet cycles that play on with corporate banks, households, which I think is favoring India. So that doesn't mean that we think India will grow at 6.5-7%. Our FY24 number also will be, I think, below 6%. But it's still, I don't think it will call for a very immediate rate cut. as Aurodeep is saying, purely because I think the inflation cycle is very different globally. So, unless Fed not only pivots, but like completely turns around and starts cutting, given that they expect inflation to be at 2%, then it's a different story. But I don't see that. I think rates are going to be higher for longer globally as well.
All right. What about bond markets? After today's knee-jerk reaction, can we expect where do we see yields go from here, Aurodeep?
So look, I mean, as far as the bond markets are concerned, I mean, I think today's policy has been broadly in line with where um, markets were expecting. And I think broadly markets are looking at, as Arvind said, 25 basis points in terms of the next um, hike before a pause. Now, it could be that they pause earlier. On liquidity, I think, you're in a situation where, you're in a situation where yes, the tighter liquidity situation will probably sort of play out. The RBI has said that you need to learn to live with sort of tighter liquidity, which is an implicit way of saying that look, if we are tightening monetary policy, that has to be in sync with liquidity also sort of remaining in somewhat tight zone, and if we will enter. But only when we see there's sort of evidence of real stress. And meanwhile, I think on the fiscal side, there's sort of going to be a lot of pressure probably next year, right? So this year, because nominal growth is good, tax revenues are fine, a lot of excesses have somehow been pushed under the carpet, right? And so we expect they'll hit the 6.4% of GDP target. But next year is going to be trickier, right? Because your nominal GDP growth will probably be around 10 to 11%, not the 16% odd, which probably we are seeing this year. And what that means is that you will not be able to rely as much on beyond tax revenue. So even though the government might come up with a fiscal deficit number of around 6% of GDP or so, you will see the fiscal consolidation is going to be tricky. Not to mention that there's also a political cycle involved, right? So we've got a spate of state elections next year in key states following the general elections next year in 2024. So I guess there are sort of pressures from these sides too. But on the flip side, the rate hike cycle, so to speak, is likely to come to an end. So I mean, our rates analysts have 7.5% for Q4 of 2022, and then sort of rise to 7.75% in Q1 2023, and then sort of remain in the 7 to 7.5% zone for the rest of 2023 calendar year.
Okay. Arvind, what are your views? And also, especially since you're joining us from London, we do want to know what is the global investor view on India, particularly global debt investors.
So on the bond market views, if you look at short-term rates, anything from overnight to 3-4 years, it's fairly attractive, right? It's at long-term averages. And so a fixed income investor can build a relatively low interest rate risk allocation and still earn 7%. Of course, it is nominal. So that is attractive. So relative to other assets, relative to fixed deposits, I think from a bond investor or bond fund investor, I think you will see more inflows. Some could be asset allocation flows out of equity because equities has done just so much better, but this general allocation. For the longer end of the bond market, I think there is the one risk that I see is supply, in the sense that banks will continue to be very big net sellers of bonds because they are seeing credit growth. And if the RBI does not put in OMOs or or support the market, and keeps liquidity negative, which would mean that the banks will have to self-fund the their credit growth. We know that deposit rates do not aid credit growth. Credit growth leads to deposit growth eventually in the system, but the initial funding will have to come from selling of government bonds. So they will be lesser net buyers. So that will be a pressure. As of now, insurance companies have been very, very strong buyers, and that has kind of supported the longer end of the bond market. But this is one risk. If the credit growth continues in the double-digit nominal levels, I think you will see some pressure on the longer term. Also, we will expect state government, banks, and banks themselves, corporates themselves, to start increasing, bond sales, supply in the bond market. But shorter end looks great. If the liquidity tightens further, then the rate spreads on the shorter end gets even better. So it gets even more attractive. From a global perspective, I think it's been very surprising, right? India had nothing, barely had opened limits in 2011, 12, 13, and we got about $50-60 billion of flows into Indian bond market. And now we have everything. We have FAR limits. We have opened up the entire space. Many people know about India. India has inflation targeting. Real rates have been kept positive, whatever, during that period. But we still haven't seen foreign flows, right? Two reasons. One is just the strength of the dollar, right? The cycle of the dollar would have meant that if you look at emerging market local currency sovereign, which is what Indian government bonds is. So you have, if you're a global fixed income investor, you have a developed markets, then you come to emerging markets and you do emerging market hard currency, and then you do local currency. So the pile of money, it's like an inverse pyramid. The pile of money for emerging market local currency sovereign is that much lesser. And when the dollar has been so strong for so many years, I think you've seen net outflows out of that segment. So that's one reason why India has not seen bond flows. Second, China opened up. China went into the bond index. So China also, whatever new flows, incremental flows came, went into China. So we don't see that changing till the time the dollar cycle changes. Once that happens, then you will actually see foreign funds going behind the government to get India included in the bond index. It's a function of demand, right? It's a function of attractiveness and demand. So if the dollar cycle has peaked and people expect Fed to also lay off, and from next year onwards you see a dollar depreciation, then you should expect more flows. But until that time, I think we should be. I don't think we should expect too much. Even if India gets into the bond index, that's again a 6 months to 9 months story, right? Once they announce it, it's going to take some time to do it. So right now, reasonable amount of fear on inflation, reasonable amount of fear on, and domestic rates in the UK or in the US are that much more attractive today. The incentive for them to take that extra currency risk, political risk to access a emerging market bond market is that much lesser. But if the tide changes, then you will see more flows.
Sure. Okay. Aurodeep, closing question. So just considering the number of factors at play, considering the RBI has said that they will be data dependent, is the terminal rate still a moving target?
I mean, look, the end of a cycle is always tricky, right? So it's a little bit like you've taken the aeroplane, it's in for landing, but exactly what part of the runway it's going to touch down is always going to be very tricky. And you're in a situation where given just the wide amount of uncertainty, right? I mean, both Arvind and I have spoken of very different outlooks on the global side, and really, I mean, it's anyone's guess what's going to actually turn out next year. So from a policymaker's perspective, I completely understand why Governor Das would want to keep options open, would want to be data dependent, would really want to see where growth and inflation go before committing to it. Now there is and to some extent, the RBI has a Fed problem, which is that If it comes up and says, oh, it's all done, we've landed, then you'll have easing of financial conditions, and then it goes kind of undoes some of the tightening that you would want to do. But on the flip side, you've also got to be nimble, and you've got to figure out what happens next. So I guess all things put together, our base case has a 25 basis points hike in Fed, but it is a close call, right? So consider a situation where, and the other aspect is also that I think the policy tolerance of higher inflation and the policy intolerance of growth sacrifice, both of it is pretty high, right? So at this point, even if inflation is at, say, 4% at 5% levels, it seems to be somewhat acceptable. And the real rate which MPC members at various points in their hiking cycle seem to be talking of is this psychological 1% level, right? So we are at around 0.8%, so to speak. So, one thing that could play out is that the RBI continues to see inflation averaging around 5% come the Fed policy. And on growth, if they still remain positive incrementally, then it's probably a good time to sort of just deliver that last hike, and then sort of pause and sort of wait for these monetary policy to act with lag. But on the other scenario that can play out is, inflation remains 5%. But your global growth kind of pivots really fast. You see more visible signs of domestic growth slowing, and at that point you're like, what, I think I've done enough, and I'll pause. So again, the odds currently are for a 25 basis point last final hike to a terminal rate of 6.5%, but the Fed meeting, in our perspective, is going to be a close call.
Sure. Okay. Thank you so much for taking time out. Stay tuned to BQ Prime for more updates on the economy. Thank you, Arvind.